Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi everyone, welcome to the Small Cap Discoveries conference call. Today on our call we have Atul Sabharwal, the CEO of Snipp Interactive. Snipp trades on the TSX Venture Exchange under the symbol SPN and on the OTC under SNIPF. The company is trading at 10 cents with roughly 235 million shares outstanding, or about a $23.5 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Atul, thank you for joining us today. Let's dive right into it. I understand you have a presentation you're going to give for us. Why don't we just let you have at it, and we'll jump on some questions when you're done.
Sounds good. So thank you guys for having me here. Snipp, is a marketing technology company that helps our customers acquire customers, retain them, and engage with them, right? So all of our clients basically require customers to be, profitable. Our platform simply helps them acquire these customers, retain them, and engage with them in this new world, right? Very simply. Key reasons why, we make a good investment is we've got, I think one of the nicest and largest base of like Fortune 500 companies. We are longstanding suppliers to Kellogg's, Procter & Gamble, Starbucks, Unilever, Nestle, Pepsi, to name a few. They all use, a market-leading engine of ours, a machine learning engine that enables them to capture specific purchase data of people shopping at stores, online or offline. And, we're the market leader in that, running all of the major platforms that rely on purchase data at our clients, facilities, right? So what that basically means in layman terms is if you take part in Starbucks' loyalty program, it's probably us running it on the back end, right? And that's how, our machine learning, engine has evolved over time and created a defensible moat, because every day that people transact in Starbucks, we get better data about those people. And because we get better data about those people, we can target them better, very simply. Right. The other reason why we make a good investment is, we have multiple revenue streams built off a single platform. Our clients have to do all kinds of different acquisition and retention programs to keep it fresh with customers. And, they deploy us in different mechanisms, given the modularity of our platform, resulting in a nice building up of our long-term recurring revenues, but not just on one type of product, on multiple, product types. We have no debt. We've been building a really a cool platform. That build, has sort of matured now, leading to us having a full year of EBITDA positive growth last year. And you're seeing, our growth really accelerate coming into 2021. 2020, even though it was a dismal year for the entire planet, it was a great year for us. Data became more important. We had great data. Shopping habits started shifting online. Our platform was right there. We understood purchase behavior inside stores when you were at a retail physical store. That really helped drive our customers and helping them understand how customers shop online. And because our platform works across channel, they had nowhere else to go really, other than to come back to us, right? So debt-free, EBITDA positive all of last year for half of the year before that. A really big bookings backlog. We did about $8 million of revenue last year. I think at this point this year, our bookings are already far exceeding that number. And I've already said that in my last press release in Q1, where we expect, subsequent quarters to have, some significant hockey stick kind of revenue growth, but profitably with no debt, right? The interesting thing is the space also has a lot of M&A activity in it. I could get acquired or I could be the acquirer. Depending on how things pan out in the equity markets. I have a significant, opportunity in front of us. to acquire a bunch of companies to grow, but just on organic growth, that we don't count our growth strategy based on an inorganic strategy. We're just looking at our own growth, but we can really turbocharge that by adding in a acquisition strategy, should the market support it. But in general, on the other side, there's been a lot of space where people have been acquiring companies like us for the data, for the customer relationships, etc. So those are some of the key themes, on the company, right? As I mentioned, I won't spend more time on this, but we've been building a profitable company. You'll see in the years prior, we did 11 million of revenue, in 2016 on a $6 million loss. We were building out our product platform. Now you'll see a significant less revenue stream as of last year, but significantly more profitable as we finish doing some of the lower margin pilot kind of like deployments that are now transitioning into nice long-term recurring revenue streams. Also, more of our clients are direct. So Procter & Gamble is a direct relationship, not coming through an agency. And that migration of clients who actually pay the bill saying, okay, we want to come to you directly as opposed to going through a third party has started increasing. Obviously, there's been some channel movement for us because now we don't get business from advertisers to the extent that we, advertising agencies, for example, like we used to before, we partner with them because the relationship has come directly from, the manufacturer, right? But you're seeing this growth, starting to happen now. Last year, the revenue top line was flat, but the EBITDA growth was quite massive. And this year, you'll see both of these growing quite significantly. Our earnings are coming out shortly for Q2, and I think everybody will be quite pleased by that. And I've mentioned this already from my, first quarter announcements. Our business remains, in the 70% average margin range. We try and target a 65 to 75% margin. So we feel pretty happy with that, and we have no debt on the balance sheet, any kind. Our focus is continuing to drive, our manufacturers. We're now working, for example, with Procter & Gamble in Asia, in the Middle East. We're working with Kellogg's in Asia. We're starting to make inroads into Europe. I just hired a couple of weeks back 2 people in the UK market. So we're getting a lot of great, a lot of great business from our existing US clients in different parts of the world, right? We're also seeing a lot of, moves towards implementing us on more long-term recurring program types. Loyalty is becoming a really big aspect of the way manufacturers have to sell into the market. With cookies going away and data and personalization and privacy becoming really important. There's very few sources of first-party data, and we are one of those leading sources that can actually help our clients evolve in this new world where you cannot actually target people based on cookies. We're continuing to see this trend where clients are coming to us to actually start creating data sets, and in different industries, from utilities to market research to CPGs to companies that sell through Home Depot and Lowe's. So we feel quite happy with where the market has evolved to. Just in terms of the company, we have a pretty significant presence in the countries in blue. We've conducted programs, globally, and we continue to expand our footprint. And we have a natural sales cycle because we can, just leverage our existing relationships with someone like a Kellogg's, where we're a global vendor, or P&G, or L'Oreal, to go into the different markets that they operate in. So, so the market, what is the market that we operate in, right? So we basically operate in a market in the marketing tech space where we help our clients, excuse me, I just have a bad cold, understand if their customers bought their product, and we help those customers to keep coming back to them. And we do it through our tech platform that, carries out loyalty programs, incentive programs, and in some cases, couponing programs, right? We don't help our clients today answer questions around who's my customer and where can I find them, or how do I target them, which is typically the media and the ad buying side of the tech stack, right? We are on what happens after you place your media. can you actually understand if someone bought your product? So this is the market that we operate in. We could get into the media market and get into ad buying because we've got great purchase data, which is very unique. So our targeting capabilities are actually going to be much better when we get into the Snipp media, into the world of Snipp media in the future, because we've got purchase data around which we can actually target people. Just very simply, there are 5 questions a customer has to ask. Any business has to ask 5 questions. Who's my customer? Where can I find them? How do I target them? Did they buy my product? How do I keep them coming back? Right? Today we operate in this space of, did they buy my product? How do we keep them coming back? Right? Now, if we understand, purchases and how and where people buy stuff, right? You can then backtrack and understand which media sources actually helped these people buy these products. So if to simplify this, right? If you go back in time, generation 1 of advertising was all about television, print, and radio. So if you started a business, you would basically put money in any of these 3 channels and you'd hope and pray someone came into your store and bought something. Very simply, right? Awesome. Generation 2 of advertising was all about Google, Facebook, Pinterest, right? And they solved one major problem, which was at least helping me as the business owner understand, did someone actually interact with the advertisement that I put out there? Did they actually see it? Did they actually click on it? Television can't tell you that, right? They can tell it to you based on a sample, right? So generation 2 of advertising was, okay, I can tell you that someone saw your ad and someone engaged with it, but I still can't tell you someone bought it, right? And it's kind of a hidden secret in the world of media. No one wants you to know if someone bought their product, because the minute you know which channel works better than the other, you won't advertise in any other channel, right? Now, generation 2 advertising didn't solve the brand manager's core problem, which is, hey, I still have to get people to buy my product for my P&L, right? And now, not only do I have to deal with television, print, and radio, but I got to deal with Facebook, Instagram, Pinterest, Rogers, et cetera, and none of you guys are going to tell me if someone bought my product, because they can't. It's impossible for them to know Paul shops at Walmart, I shop at Costco, Trevor shops at the bodega down the road, right? Because you can't connect into all of these companies, and none of these companies actually want to give you their customer data. So if you think of a Kellogg's, you might eat Kellogg's cereal every morning, but you're not a customer of Kellogg's. You're a customer of the retail store that you shop at, right? The retail store is the customer of Kellogg's. Kellogg's sells to the retail store sells to you. But Kellogg's business is driven by you, not by the retail store. But Kellogg's business has to care about the retail store, because if they don't care about the retail store, they won't sell Kellogg's. Then what happens to Kellogg's, right? So, we've basically figured out within this chain of 5 questions, right, that if you understand who bought, where they bought, how much they spent on it, what else they bought, right, that data set is super valuable for all of these clients of ours, right, that, come to us to run various kinds of programs around customer acquisition, retention, and engagement. So, I won't go into the depths of our platform, but, we basically solve 3 simple problems for clients. One is we run tactical shopper marketing programs that drive Paul and Trevor to buy product, very simply, right? Or try product, right? It could be an instant win, it could be a sweepstakes, it could be a points-based loyalty program. Secondly, we help them enhance their data collection, right? Through our platform. Data about Paul. What did Paul buy? Where did he buy it? At what time did he buy it? What else did he buy? Right? Data that they don't have about Paul, because Paul's not a customer of Kellogg's. Paul's a customer of Loblaws, right? Loblaws has Paul's data, but Kellogg's doesn't, and Loblaws will not give Kellogg's that data, because why would any business give a vendor sitting on a shelf? Any business, why would any business give a vendor their end customer's data? The customer will just sell to them directly, right? So we solve for that. And then we give them a lot of great data about Paul and people like Paul shopping across the national ecosystem. How we do it? We have a platform that allows Paul, sorry, Paul, I've been using you as leverage here, to simply take a photograph of their purchase receipt as one example. And when you send in that picture of your receipt, we know what you bought, where you bought it, how much you spent on it, what else you bought. And that data is tremendously valuable because it's not available to a Kellogg's or to a Starbucks when you're buying Starbucks in Walmart, right? It's available to Starbucks when you're buying Starbucks in Starbucks. But when you're in Starbucks, you're only buying Starbucks. You're not buying everything else. And Paul's more than just drinking Starbucks. He also has to live and eat and wear clothes and everything else, right? So we get that great data set, right? Well, maybe not, but so, we've got a pretty modular, I won't get into the technology, like tech stack, that allows for a whole bunch of AI around Paul's purchase habits. Starts with that receipt that we get from Paul. Paul gets points. Paul's happy to send in a receipt because he's getting Starbucks points that he can redeem for all kinds of good stuff from Starbucks. Or you're getting Air Canada miles as an example, right? When you fly on Air Canada. But that data set that we keep collecting about Paul and building on, right, allows us to carry out all kinds of different programs to solve various kinds of, issues that clients have, various kinds of marketing needs that they have, from, understanding user behavior, understanding, new products that they're launching, helping increase the basket size, helping drive participation, and building their CRMs to build a direct data set about people like Paul, et cetera, right? So, the kinds of programs we run are diverse. We've built a unified platform that allows a client to solve for different types of programs for different needs. So here's an example of some of our programs with our larger clients. All of these are our clients today. And we've been working with them for 2-3 years, trying to test the hypothesis of is someone going to do something to get a discount or get points? As an example, send in a picture of their receipt. And the answer to that question is a resounding yes, which is why our revenues have started ramping. And we do it not just for large companies, but also for smaller companies, right? And we do it not just for B2C companies, but also for B2B programs, where companies like SIG, they want to incentivize distributors to stock their product and sell their product. Same problem. The salesperson at a distributor or at a Nordstrom retail store is not an employee of SIG, right? So if in the world of Nike selling through a Nordstrom's a large retailer, the employee of Nordstrom has no incentive to push Nike products to you when you walk in the department store, but you create programs for them. So we do a lot of B2B programs, a lot of B2C programs. So yeah, I think I'll stop here, because I think in essence, this is what we do as a company, right? With the idea of leveraging our data, right, intelligently with our clients to give them great insights about, the company. Since you only gave me 20 minutes, I think I'm at the 20-minute mark, right?
I mean, certainly, if you want to continue, if you think there's something important, by no means you have to stop here. I'll sort of leave it up to you, or we can jump into questions. It's up to you.
Let's jump into questions, and I'll try and leverage some of these other slides as needed.
Okay. Perfect. Okay, so you've done a great job of sort of describing, walking through what the proctor really does and how do you go about, doing what you do for your clients. But give us a sense of your business model. How do you guys actually get paid for what you do? And is it long term? Is it short term? Is it per click, so to speak? Describe the sort of the revenue model for you.
Right. So our revenue model is we have 3 pillars of revenues, right? 2 of which are SaaS type businesses, and one is more of a repeat kind of project business, right? So clients hire us to do, the way you bucket out our revenue streams is we have a bunch of money that we make. About 40% of our revenues are promotion driven, right? What is a promotion? A promotion is any program in our world that runs for 3 months or less, right? It could run across Mother's Day, Father's Day, Brother's Day, Halloween, back to school, Christmas, New Year's, et cetera, right? There are 80 promotion windows in a year that a client has to run some kind of promotion. Why? Because what happens is that when you are going to a Loblaws to buy a product, right, what you get exposed to on a Walmart, Loblaws website or in store, right, is determined by Loblaws, right? So let's take an example of Coke and Pepsi, and I'm the buyer at Walmart, right? The conversation I'm having with the buyer at Walmart between Coke and Pepsi is, hey, it's Thanksgiving is coming up or Christmas is coming up. I'd like for you to give me more exposure in store and online, right? I, as the buyer at Walmart, will be like, why? Are you dropping your price? The Coke guy would say, sorry, I can't drop price for you because if I drop it for you, I'm going to drop it for everybody per my contracts, right? Pepsi says, you know what? I'm not going to drop price because I can't. They don't even have that conversation anymore. But I'm going to run a program where if you buy six pack of Diet Pepsi, I'm going to give every one of your customers a $5 Walmart gift card, and I'm going to pay for it. And you don't have to do anything, right? Guess what's going to happen during Christmas? Pepsi is going to get more exposure in each of 5,000 Walmart stores, in Walmart tweets, in Walmart emails, online at Walmart, right? Their revenue is going to go up for that promotion window. That conversation at the Diet Pepsi level, it's not at the corporate Pepsi and the corporate Coke level. It happens at every single brand level, right? Happens about 80 times in a year at select windows. Like I said, and that's the promotion business, right? So even though it's not a SaaS revenue stream, it's pretty much a repeat revenue stream because they have to do something every quarter, because if you're not doing a promotion every quarter around certain brands, you're losing market share basically, right? And that's one example of a reason on promotion, right? So this is about 50% of our business. How do we get paid for it? Simple, anywhere from $50,000 to $150,000 a program. Very simply, right? The other two parts of our program, of our platform, which the same platform can be leveraged in different ways, excuse me, is our loyalty solution and our licensing solution, right? Those are more smoother, long-term recurring revenue quarter contracts where we get paid per quarter, a license fee for our platform. In essence, any of these three elements breaks down into a setup fee, a monthly fee, and a transaction fee. So the transactions are determined by the number of receipts going through our platform, or transactions going through our platform, or the number of incentives being distributed. How many Walmart gift cards have I given away, right? But we're not an incentive-based only revenue model because we are classic software as a service, right? We're more not SaaS, but PaaS, platform as a service, right? So we license our platform to clients and we execute it for them when they ask us to. And depending on that, and depending whether it's a 3-month program or a always on loyalty program, right? We clip a coupon every quarter, and that number is based on a combination of the months we're running it for and the potential transactions going through it. So that's our business model right now.
Mm-hmm. Mm-hmm. Now you've got some big well-known brand names out there. Give me a sense of customer concentration, if any. What's the biggest client you have in terms of percentage of your revenue?
I think 3% or 4% is max.
Okay, so nothing.
We have 91 unique brands who worked with us last year.
Mm-hmm.
Now again, remember, we are a Nestle corporate vendor and a P&G corporate vendor, but that only means that I have the license to work with any of their 200 brands, right? Because all the budget and all the decision making and this dynamic, right? The next time you walk down the aisle of a store, every single inch of that aisle or every single vertical on your Amazon page is negotiated for space, whether it be online or offline. And the manager for that particular brand is responsible for her brand, right? Mm-hmm. So the key was, when I think the market doesn't necessarily, and partly my fault that I didn't explain it, to become a corporate vendor is one thing, but without doing that, you can't actually get the business from the brands. So sometimes it takes years to become a corporate vendor because they need to make sure that your security standards are up to spec. You're dealing with consumer information here, right? Mm-hmm. But we are literally, when we announce an MSA, it means we've got a corporate status with a client. I have a call tonight at 10 o'clock with Shiseido in Hong Kong, right? Shiseido is a Japanese brand. We just became, a global vendor for them. Now every single brand, I'm just preparing for it this evening, right? Every one of their perfume brands will do their own, promotions or loyalty or cashback or license components of our solution for their needs. And we're not, the other question that is relevant to your question is how penetrated are we in P&G or Kellogg's or, Kellogg's is probably my largest client and I do one program for them a year. One always on program, right? Mm-hmm. But I'm not more than 8 to 10% penetrated into any of P&G, Johnson & Johnson. And I'm talking about penetrated in the US market. Forget the international market. That's a whole separate story.
Lots of growth ahead. Give us a sense of the competitive landscape. Who are you competing against, and kind of what makes you different or better than any of your other competitors?
Right. So here's the way to think about, in these three pillars of, as we've articulated them, right? Promotions, loyalty, rebate solutions, right? There are a lot of horizontal vendors, and I didn't go through the product stack per se, and maybe I should. But the way to understand this is that we have a lot of vendors who are horizontally focused on one of few things. Like take the world of loyalty that is the most visible to most people, right? You have a company in the Toronto Stock Exchange called EMEA, right? But all they do is loyalty, right? If you ask them to do a rebate program, right, they won't be able to execute a rebate program because that's not their business. And our platform is like an ERP that goes horizontally across an organization to do any kind of program. If tomorrow Air Canada were to invite us to a loyalty bid, we'd be able to respond to it and actually give them a better solution with more functionality than EMEA's solution for loyalty. What I would not be able to give them necessarily is the services, because I don't have people. High cost. Eventually we'll launch services around our platform, right? EMEA has that, right? But all of these companies that you're seeing here that are listed as competitors also license our platform for certain components. And we've gone from being friends to frenemies, and in some cases, why I mentioned EMEA, pure enemies. Because we get invited to an RFP and they're like, well, we just have your component in it, which is like the differentiator for that RFP. So why are you? And I was like, well, I have what you have. You don't have what I have, but you have a better name, than I do.
Right. Right.
So that's the way. Yeah.
Gotcha. Let's talk about COVID over the last year and how it's impacted your business. And if anything, what do you think COVID has done to change the mindset of your customer, or sort of change the opportunity for you guys? How would you?
Yeah, I'm coughing right now. I got tested. I don't have COVID. The world has opened up, and my kids are out there swimming and coming back home with common cold. Which
I know the feeling. Yeah.
So, it's a good question. So I think what happened with COVID was, we've always been a pretty distributed company. The first tactical piece of this is that we don't actually have to keep costs low, and because I believe in running an EBITDA business, right? We've had a very distributed workforce, finding the right people in the right cities, irrespective of where they lived, right? So we didn't have to shut down, in any form or fashion, right? And that keeping everything going and suddenly moving things at the click of a button from a retail only offer to an online offer, that flexibility that clients finally witnessed because of COVID was hugely eye-opening for them, right? That was number one. Number two, the promotions business tends to work a lot better when the economy is down. Think about it, right? People are worried about money. You need to discount stuff. You need to run a promotion for them, right? So some of that started happening too, right? But I think what started happening from a more long-term trend was because a lot of things moved online, right? A lot of our clients realized that, wow, the amount of data that you can get from people shopping online, right, is a lot more than you traditionally can get from someone shopping at a Walmart, right? Isn't going away. But what if we could replicate some of that in the offline world when it comes back? So they're like, oh, but Snipp, you can do it because you've got, I can tell you from your receipt, my receipt engine as an example, what you bought, where you bought it, how much you spent. I can give you your basket data. I can give you a whole bunch of data about you, right? So I think, they realize the importance of loyal customers a little bit more, right? And honestly, think of any of these brands that I was talking to you about. Their business just exploded during COVID, right? P&G's best years in its planet were during any CPG company, toilet paper, coffee, hoarding, Kellogg's, sold out. Kimberly-Clark, they're still suffering from, having no capacity, like any of these companies. Clorox, Lysol, right? It went crazy for them, right? From their own business, their revenue, if you look at their earnings, it's just been astronomical. Now they're getting worried, right? So they made a lot of money. So now they're spending it on us because they're going to plan for the future when they have overcapacity, right? It can't last. Who knows? But like you see, so I think we've fortunately benefited in a very unfortunate time, right? From COVID. Also, some of our competitors went out of business, I would imagine, because it's been a tough environment, right? If you're only doing one thing in a retail store, right, or you could only do a loyalty program tied to a physical store location, what happens, right? So the availability of good employees and people that make or break a business, right, has become quite interesting for us. So we've recruited a few people over the course of COVID, that hopefully can help further take us forward to the next level.
I noticed in one of your relatively recent press releases, you landed a contract with one of the Canadian provinces. What can you tell us about that? I'm anxious to hear what a province would do to sort of advertise whatever services they provide us. Yeah.
That's really interesting. So these are all new markets that we've been chasing specifically, right? This province in question wants to incentivize you to get out and about. So they'll subsidize your travel. It's a promotion.
Okay.
Stay at a selected list of Airbnbs or small hotel operators, get dollars off your booking. Take part in activities, right?
Yeah.
And traditionally during the last year and a half, people have been, you don't want to go to a crowded place. So that's changed in a heartbeat, at least where I live. We'll pay you for it, right? And that's the simple program, right? And it's not one province. We have a second province too, a much larger one. But that would be an interesting one if their rules change like this particular province's, right? So that should launch in the next. Jason, do you know? It should launch in the next couple of weeks.
Yeah, it should be launching this summer.
And I'm anxious to hear, is it based on the same sort of format where you're taking a picture of a receipt of some kind and sending it back, or maybe give us some more details on how it actually operates?
So traditionally, what this province would have had to do was have people mail in their hotel receipt or their activity receipts, and then send back a rebate check in the mail.
Yeah.
So with us, we can launch it across a wide ecosystem of hotels without any pre-planning with those hotels, right? It's all based on users submitting, right? So you would submit a picture of your hotel receipt, and you would get back $100, $200, I think. It's a pretty rich program. I can't remember the exact numbers, but that's how it is. It's a digital rebate program. That's all it is.
Right. Gotcha. Let's talk a little bit about your financials, and we'll get a little bit into the stock. You mentioned that you're debt free. Maybe give us a sense of kind of what your balance sheet looks like, cash, and I guess ideally, what are you going to do next? You mentioned potential M&A. Let's talk balance sheet, and then we'll sort of talk M&A a little bit.
Jason, do you want to talk about the balance sheet?
Sure. So in the last several quarters, as Atul mentioned, we've been EBITDA positive, which was allowing us to not have to either dip into a working capital line of credit if needed, or do any financings. So we've been able to maintain a healthy balance sheet with cash and AR balances that is around about 3 to 4 million. And so that gives us, a lot of healthy breathing room. Our liabilities on the balance sheet, primarily a big chunk will be our deferred revenue that will fluctuate from time to time, as we do sometimes get more billings out to our customers ahead of their actual delivery start date of some of our programs. And one item that is a little deceiving is we have a fairly large accounts payable and accrued liabilities amount. So it's around, it's over 2.5 million. However, a large chunk of that, about 40%, is inherited liabilities from an old acquisition that we will probably be in the process in the next year with our auditors to look at writing off and de-recognizing that liability. So really the liabilities presented on the balance sheet aren't necessarily reflective of true liabilities, primarily because we are, having to follow GAAP, IFRS accounting regulations, and our auditors need to make sure that anytime anyone looks at trying to de-recognize a liability, there's a lot of hoops that need to be gone through. But we've been having those discussions regarding the liability side. specifically those inherited liabilities that are past the statute of limitations for a creditor to come back and collect on that. They would have needed to reach out to the company within a certain period of time, initiate either a collection action or something like that. So from our balance sheet standpoint, based on that, we're in a really healthy position to continue moving forward without doing another equity raise. And primarily, we would look at doing an equity raise if we felt our valuation was reflective of, the company, what we've been delivering would be. But because, we haven't invested a lot in investor relations, we've kind of had our stock price kind of not really seeing much action. We're hoping that as we continue to show, EBITDA positive quarters, growth in the top line, that organically we'll get more push in our stock price. And we are looking now at potentially exploring at other IR programs to get, our company out there to potential investors. But really we're trading, I think, everyone that's in the senior management team and our board feels that, it's extremely a low valuation, right? We're trading at a roughly less than 2 times revenue. And we, as Atul mentioned, we have no debt and, positive EBITDA for 5 straight quarters. Everything's looking positive. There's potentially these transformational deals that we've announced. Some have already closed and some we're still in the bidding process that could, Atul didn't mention those as a part of our organic growth. We could, if we land those, have transformational top line growth that could really take us to the next level. So that's kind of where we are at a financial basis. And then from a valuation basis, we all feel that, we're significantly undervalued, primarily because, we have not focused on putting our company out there while we, have been really focused on just delivering on our revenue and our EBITDA performance.
That's great. And the other thing I noticed in regards to some of the stuff you spoke about is that you announced bookings. And if I remember the press release correctly, and I think last I saw it was about $7.5 million in bookings, but I don't know if that was updated in your last set of numbers or not. Maybe give us a sense of what that looks like right now. I guess bookings backlog, I think that's how you describe it.
Yeah, so our bookings backlog, we end up, as Atul mentioned, we have a lot of different contracts where we'll be delivering into the future, or we'll have contracts that are signed like today, but they're not going to go live until maybe later on this quarter or in the next quarter. So when we mention the term bookings backlog, those are actual contracted revenues that we have locked in that will be delivered and recognized as revenue in future periods. So we've been happy to see growth in that bookings backlog. So I think you're referring to, we said at March 31st, we had bookings backlog of about $7.5 million. So as of March 31st, we have already locked in recognizable revenue that will be recognized in future quarters of $7.5 million. And that just keeps growing as we keep signing more contracts. And that's kind of what led to Atul's quote in that same press release, that we're seeing, anticipating a lot of growth in our Q2 revenue compared to last year's Q2. And that is, again, looking to continue to roll out over the other quarters this year.
And marketing can be, call it seasonal. Do you guys see any kind of seasonality or move as far as fluctuations in quarterly numbers based on time of year?
Honestly, you're too small a company. If any company at this stage says they have seasonality, they have a problem in their business model. Honestly, just my personal opinion, right? But yeah, there's a natural, a lot of promotions get executed in Q4, right? So Q4 is typically, bookings, you've already done the work before Q4 to get into Q4 to execute the program. Right? The revenue is recognized when you do the work, right? So sometimes Q4 is a iffy quarter, right? From a revenue recognition perspective, more of a planning quarter for bookings, right? But again, like I said, at this stage of a company which is sub 30 million, seasonality.
Not that big of a difference. Okay, gotcha. 235 million shares outstanding roughly. Give us a sense of what the breakup is there in terms of insider ownership and maybe other significant shareholders of the company.
So our biggest shareholder is a family office that owns about 25%.
Okay.
Management and insiders own how much, Jason? 25%?
Well, the reporting insiders, we have about 12-ish%, but then we have, close business associates. If we include all of the reporting insiders, the family office as a control person, we have above 40% in that group.
Right. And then another 25% to 30% is actually owned by one broker dealer in Canaccord in his book.
Okay.
And he's been with us since the beginning. So, I would say about 65 to 70% of our float is actually owned by three groups: our family office, management insiders, friends and family, and this one broker dealer who's partnered with us from day one.
And you'd mentioned that, if the share was, if the stock's trading at a more, value reflected price, that you do a financing, what would you use any additional capital for if you were to raise equity?
So, here's what I would use additional capital for, right? I literally can, P&G works in 120 countries. As does Nestle, as does Kellogg, it's probably 150, not 180, right? Right now, we have programs running for Ipsos, which is a large market research company. I don't know if you guys know Ipsos, right? But Ipsos literally has programs running today on 39 countries on our platform for one of their clients. So the first thing I do, and this is what I'm doing today with our extra cash, right? So we're generating EBITDA, I'm just reinvesting it back. What am I reinvesting it in? I hired a head of sales in Europe, plus 2 more people in the UK market. That gives me coverage in the short term for Western Europe, right? I need to hire a head of sales for Asia, right? And I need to hire 2 or 3 people for the Asian market. Same clients, right? Now, with that sales increase, right, we also have to support them operationally, right? So the first use of a couple of million would go into building my global footprint, right? Because I already have a captive set of clients who approved us, globally to work with them. And we've already executed pilots with them, so they know what works in America works somewhere else too, or Canada, right? That's the first thing. But, I have the ability to roll into our platform some of our vendors, right, that we work with, right? There are potentially 15 to 17 companies that I could think off the top of my head that would make great targets for us to add to our platform as an ERP. So if you think of SAP as an ERP solution, they have a financial module, they have an HR module, they have, a marketing module, right? We can add different promotion type verticals into our stack, right? And all we need from them is really not the technology or the, few people, but just their clients, right? Who already invested in their platforms. So all of the model that we've built here allows for us to strip out all operations and all tech and just keep sales and marketing, not even marketing necessarily, but just the client that these platforms have built because they're vertical. We are horizontal, right?
Right.
So that's what we would use the money for, right? I'll give you a simple metric here, very simple example, right? We do about 300 to 400 programs a year, give or take. Let's just say 300. For each of these programs, our clients are spending anywhere from $100,000 to $2 million of budget on advertising before we even start off for the programs that I'm doing, right? So think about this. If I started a media business or a programmatic buying media, service, right? For my own programs, right? For these same programs that I was showing you, right? I mean, some of the media budgets I don't want to mention because y'all won't believe me, but you can imagine it's like a Starbucks or a Kellogg's or a P&G are spending millions on advertising this program, right? So if I do the maths and say, okay, I have 300 programs, what's my risk mitigation strategy if I start a Snipp media business, right? If I can get half my clients to spend $100,000 of their media budget with me so I can place the media, as an expansion of the share of wallet of the program that I'm doing for them. I'm doing everything post-media anyways. Do the maths on that, even if it's a 20% margin business. Well, how do I enable that? I could buy a company that's a programmatic company that's trading at less than 1x multiple. I need to have enough working capital to make sure I can support it, right? That would be an example of an acquisition.
Makes sense. Makes sense.
And if they have their own revenue, even better, right?
Yeah. 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 So as investors, what do you think are the key metrics we should all be watching for to sort of show that you guys are executing on your business plan? Apart from just revenues, I mean, clearly revenues are always a sign that things are working, but you've seen a flatlining of revenue and you've seen your profit grow. So clearly revenues alone aren't the only thing to look at.
And that was by design, right? Because our biggest investor is a family office and they said, we need you to be EBITDA positive, don't dilute anymore. Okay, if that's what you wanted. So, I think the metric to look at us is really top line and bottom line. I mean, at the end of the day, we are a profit maximizing entity, right? So, and we're a public company. So if I'm not generating EBITDA, I mean, I am optimizing on both variables right now versus any one variable. If I raised some money, right, then I would say measure that KPI on revenue growth and bookings backlog, right? It's okay if I'm losing money, and that's exactly what we were doing in the early years of the company, right? So if you look at our metrics, sorry, I had a slide on this. If you look at our history as a company, right, in the early years when we actually, for the first few years, right, we went public in 2012 with less than 2 million Canadian that came into the treasury. And what was the idea? Investors were like, show us that this is actually a product people would want. And that was simply an engine which allowed users to snap a receipt and the machine learning that started back then, right? That took us to 3 million, very rapidly, profitably, funnily enough. We had 8 people in the company. And then they said, okay, we'll give you 10 million more, right? What are you going to do with it? I was like, well, we're going to take this receipt engine and build a solution around it so that you don't go to a client with a tech piece, but you go to them with a marketing solution. Hey, do you need to do a cashback program? Do you need to do a loyalty program, right? So we can build towards the vision of having a, customer acquisition and retention platform, right? They said, great. If you do that, what we want to see then is, that business that you're doing evolving from being just promotions into other types of revenue streams, because that shows that people need an ERP with a unified view of the data, right? However, if you go back to the how we spent the money, you'll see that when we raised that money, we made a $6 million loss, same top line, right? And we said we need 2 to 3 years to do this because then we'll buy and we'll build, right? But when we come out of it, we'll come out of it with about the same revenue, give or take, but we come out of it profitably. So the mandate with our original investors were, hey, we don't want you to lose tons of money unless you've proven that it works. So the first was build the MVP, then was build the ERP, so to speak, which is where we are, right? Like, and then once you've bought these companies, right, integrate them, and that's where we are, right? So in phase 2, we were buying companies. We bought 2 or 3 different tuck-in acquisitions, people as well as tech, and then we integrated them in our phase 3, and we're at the end of that build right now, and which is why revenue is ramping profitably, right? So if now we raise money, the idea would be, okay, spend it on buying acquisitions that will actually leapfrog. If I this year grow from 8 million, what's a healthy growth rate? 25, 30%? Okay. Let's say I'm growing 25, 30% with EBITDA growth. How do I take that and say, how do I grow from, 8 million to 25 million, given 2021's half over now, right? And we know where we're going to end up this year, right? In the span of the next 24 months. I could do an acquisition like the media acquisition I was talking about, right? If I could support the operating costs of it in the short term. So we'll go back. So the long answer to your question on metrics is, right now, today, given what we know and what we're doing, it's both top line and bottom line, because our strategy is to reinvest our profits. We want to be EBITDA neutral. Let me just put it like that. And show the revenue growth, because that shows our model works, right?
Right. Yeah.
But then if we raise some money, we'll go negative, but then the amplification of the top line will be faster.
Right. Yeah, good point. Listen, a couple of times I think you sort of inferred that you think the share price is lower than it should be. Why don't you, I'm going to give you a chance to sort of give a parting message to investors. What do you want investors to know, and maybe what should they look forward to, say, in the next 6 to 12 months? This is your parting message. Give them the hard sales pitch.
They're going to be very happy. Period.
Very succinct, very to the point. So that's good. Well, listen, I mean, this is the first chance to properly introduce the company to our subscriber base. So Atul, I want to really thank you for spending time with us today. I think we've covered a lot. Certainly, it looks like you're growing nicely, and we're always happy to hear about companies that are growing and are at the very least EBITDA positive. So we're going to continue to watch what you're doing. And yeah, I just want to thank you for the time today, and look forward to catching up to you in the future as well. Okay,
sounds good. Thank you so much. Appreciate the opportunity to talk to you guys. I mean, this is the best cold email we've ever received. So,
if somebody wants more information on the company, what's your website address?
SNIPP.com.
SNIPP.com. Perfect. Nice and sweet and easy to do. Okay, thank you so much. We've been speaking to Snipp Interactive CEO Atul Sabharwal and Jason. I want to really thank you guys again for joining us today, and let's stay in touch, and we'll keep up with the progress.
Yeah, absolutely. Take care, guys.
Thank you.